And Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. And Victoria, I feel like we're holding our breath with every inflation number to see, is this going to confirm the 50 basis points the market has priced in for September? What do you think?
Yeah, Amber, I think you're right. It is something everyone's looking forward to every time that there's an inflation number coming, because they can have such movement with the market. The volatility can be quite extreme. I don't think today's number changes a path that the Fed had laid out previously. I don't think this means that we get a 50 basis point cut in September. I do think it probably validates the Fed starting to make cuts, so maybe a 25 basis point cut. The big number will be tomorrow with the consumer price inflation. We know that consumers are becoming wary. There's some trepidation there. And so I think that will be an important number. Those are the numbers, the annual numbers, where we still have a 3 handle on inflation. So today's number was good, and the market has accepted that. And we've seen some progress in the market today. But I think tomorrow will be more important. Plus, we have retail sales on Thursday, which talks about the consumer and its options expiration as well. So lots of things that can cause volatility this week.
So have you do you have a definitive call on what September holds in store in terms of monetary policy? Or are you waiting to see how those data points come in?
I think it would take something really outside of expectations to do anything other than a 25 basis point cut. Again, next Friday will be Jackson Hole. I think that's where Powell can really lay out his plan and let the markets know possibly what the Fed will be doing. Obviously, they're data dependent. More information is coming. We will have another non-farm payroll report before the next meeting. So things could change, but I think they will try to lay out their plan at the end of next week at Jackson Hole. We are looking at 25 basis points in September, and then another possibly 25 in December, taking a break at the meeting in between. I think the market is telling us that's what they can handle right now.
It's interesting you say that because we are seeing pricing that suggests maybe it'll be a little bit more aggressive. Let's extrapolate what your worldview or your expectations would mean for equities. Do you think equities can remain resilient as they have been if we only get that 25 basis point cut?
I think it really matters how the Fed puts this in place in regards to why they're cutting for 25 basis points or 50 if that's what they decide to do. Is it because there's concern around growth, which we've seen a lot of elements of that in the labor market and some of the consumer spending and manufacturing. We've seen that weakening. Or are they lowering because they are confident that the market can handle that and inflation is continuing to come down? CPI will give us a little more information on that tomorrow. So I think it's the reason why they're lowering that the market will take and decide which way it's going to go from there. In my opinion, I think it's going to be because of a weakening economy, which is not great for the market over the rest of the year.
Well, I think it's important you bring that up because I would say a lot of these earnings are telling us that, right? We are seeing a slowdown, regardless of the reaction. Like Home Depot is a great example of that.
Right.
Their sales are falling, but the stock is moving higher. Maybe Walmart later this week will be another test of what's going on with the consumer.
Absolutely. And consumer is key, and it's related to the labor market. And we've seen weakness in the labor market. Job openings down, quits are down, wages are stagnating. It's taking longer for people to find another job. Hiring levels are down. So that all tells us there's weakness in labor, which means weakness for the consumer. Home Depot is a perfect example. In their guidance, they talked about their concern over the consumer going forward. That's what brought the stock down initially this morning. So I definitely think there's more to watch as we get more retail earnings over the next couple of weeks and retail sales later this week.
So then talk to me about how you're positioned in the portfolio. Are you going back to those dependable growth stocks in the Magnificent Seven? Are you adding more defense to the portfolio? What does it look like?
So for our clients, we try to step back and take that longer term look. And when we do that, we think we want to have a little more defensive posture in our portfolio. We may not get a full on recession, but we think we'll get a pullback in growth in earnings in the equity markets as well. So we want to play a little defense. That means we like staples positions in our portfolio. We like some banks, some financials like a JP Morgan that we own currently because of the yield curve as the Fed starts to lower the short end of the curve, we'll get a re-steepening, which is good for the banks. And we just think you can still have some exposure to some of those growth names, but try to find some at good valuations. Those really expensive growth names, I think, will continue to pull back a little bit. So we'll try to avoid those.
It's interesting you talk about JP Morgan or the banks in general, because on one hand, there's the rate story, which could help. But on the other hand, it's, if it's because of a slowdown, how does a bank outperform in that environment?
Yeah, it's a really interesting question, because when you look at these large banks, or when you look at any company that you want to add to your portfolio, and especially when you're looking at a downturn in the economy, what are you looking for? You're looking for companies that have solid earnings, predictability of earnings, good cash flows, so that they can withstand volatility and you can hold them as a base holding. JP Morgan, in our opinion, is kind of the best of the breed in the banks, and they fit that mode. You've got net interest income up 34% year over year. You have strong cash flow. Like we said, we'll get a steepening of the yield curve, which is important for them. So I think there are some elements that keep that as a solid position in your portfolio, even though we could have a downturn. We're not talking credit cards. We've liked those for a long time, and you can hold them. Not sure I would add to them right now. But as far as the banks go and getting that difference between deposit rates and lending rates, I think they could have an advantage here.